name is Caitlin. I am a current second-year student as well as the Student Success Assistant at the Lakehead University campus. And I would just like to welcome you to today's workshop titled Intermediate Investing. So the Canadian Foundation for Economic Education is pleased to partner with the National Bank of Canada to provide a series of workshops to help post-secondary students across the country get a better handle on their money. Today's session will walk you through various risk mitigation strategies, what's involved with picking stocks, and some alternative investments. This workshop will last about an hour, and as Melanie mentioned, we will have a Q&A session at the end of the presentation. So feel free to take notes or use the Q&A function, and we will help you out there. And as Melanie mentioned as well, we did send out that pre-workshop survey where you can have a chance to win one of 2 Tim Hortons gift cards. And we won't use your email address for any other reason except for the draw. So first, a little bit about the program. The CFEE and the National Bank are offering students access to a variety of financial literacy workshops. And this is through the program called Help Managing Your Money on Campus, which is designed to help support young people by providing you with comprehensive financial education modules. And this is really important now more than ever as we live in a really complex financial world. And the majority of you have likely experienced the world of financial costs and responsibilities and financial planning, spending, debt, credit cards, and so much more. And that is exactly why they've partnered with universities and colleges all across the country to help equip students with the information that they need to take on all of life's financial challenges. So we've asked students what their priorities are in the first half of 2020 and what they wanted to learn more about. So after 1,500 surveys later from students all across Canada, this is what we found out. So 76% of students listed investing money for the future when asked specifically about what topics they wanted more information on. 64% of respondents wanted to learn how to deal with financial stress, and 55% of respondents want to build a financially healthy life. So we hear these questions and we understand your challenges, and that's why we've put together today's presentation. So investing in stocks, bonds, and cryptocurrency and real estate is a great way to expand your financial skills and include additional streams of income. But there is, of course, information and terms specifically that you will need to be aware of before investing your hard-earned money. And that is the primary goal for this webinar, which is to educate everyone with the information they need to make your own choices about your investments. So to start off, it's worth mentioning that in the world of investing, there's a lot of jargon or special terms, but that's really common for any subject. So of course, in the business world, we're no stranger to lingo like bang for your buck or due diligence. And I just mentioned these terms because you may be more familiar with them than you are with other investing language. But either way, it speaks to the fact that every subject area has its own terminology. So today we're going to go over several terms and teach you their meaning so you can start speaking the language of investing. So we are going to throw a poll up right now. And we just want to check how familiar you are with the terms on this screen here. So we have words like exchange or asset allocation, direct investing. And we want to know if you're familiar with all of these terms, some of them, most of them, or if we're really not sure about any of the terms here. Right, so some responses, we're getting a lot of some of the terms, most of the terms. All right, so we have, most of us are saying some of the terms, maybe most of the terms, which is completely okay because we are going to go over these terms today. So first, we're going to take a look at the investment strategies that you can use to reduce your risk. And next, we'll look at the techniques and strategies used to choose stocks. And finally, we'll cover the alternative investment options and the benefits and risks associated with each. And coming out of the workshop, we hope that you will become more comfortable managing your investment risks by applying techniques like dollar cost averaging and diversification to your portfolio, as well as be able to analyze and understand the potential long-term value of a common stock of a company you choose to invest in and the important metrics to follow, as well as know about some alternative investment opportunities and try to diversify and enhance your risk-adjusted returns. So first, let's cover some investment strategies that you can use to reduce your risk. So we'll be reviewing some strategies to reduce your risk while investing. The first being diversification, which we will watch a video about. The next being asset allocation, which is a natural extension of diversification and something to keep in mind, as asset allocation has been proven to drive 80 to 90% of our portfolio's returns over time. And third, we have dollar cost averaging, which is a simple strategy to make a regular investment of a fixed income in an asset. So first, we will start playing this video here about diversification.
When you invest in a stock, you're taking a risk that the value may go down rather than up. Okay, we get it. Investing can be risky. One way to manage that risk is to learn about asset allocation and diversification.
I don't know why I keep stopping. Sorry, one sec. It gets to like a certain point and then it'll stop. Okay, I think it's working.
When you invest in a stock...
What? Okay, like it's working on my end. Caitlin, you can see it and hear it?
It does pause and stop, but it looks like it's going okay right now.
Okay, I'm just gonna
When you invest in a stock, you're taking a risk that the value may go down rather than up. Okay, we get it. Investing can be risky. One way to manage that risk is to learn about asset allocation and diversification. Asset allocation is financial lingo for how you distribute your money across types of investments, like the strategic decision of which baskets to put your eggs in and how many. The different baskets are called asset classes. To help you decide where to put your eggs, ask yourself, how much time do you have before you need to use your money? How comfortable are you with risk? And how does your current financial situation look? Diversification is about strategically putting the right mix of different eggs in each of your baskets. The key is that you shouldn't invest all your money in one company, one industry, one country, one anything. Ideally, you want your investments to be negatively correlated, so when one is going down, another is going up. Here are some typical ways to diversify your portfolio. Invest in companies in different countries. Own stock in small and large companies, and invest in companies in a variety of industries. One downside to diversification is if one of your investments does very well, you won't make as much as if it was your only investment. Conversely, if you owned only one stock and the company went out of business, you would lose more money than if you had diversified your money. Diversification won't eliminate risk, but it's a smart way to manage risk while allowing you to build your portfolio.
I think when I went to go mute myself, for some reason it stopped it, so I will now mute myself.
That's okay, we power through those technical difficulties. So the main takeaway from that video is to remember not to put all of your money into a single investment. By diversifying your investments through diversification, you'll expand your investment portfolio and you'll rely solely on more than just 1 to 2 investments. So for example, we could say one of your stock investments is down for a few weeks or more. By diversifying your portfolio, you will reduce the risk of a loss from your investments. So one of the primary rules of investing is to diversify, and through this you can reduce risk, which can be achieved in a variety of ways. So in a nutshell, diversification means not putting all of your eggs in one basket. You will want to have a really good mix of different kinds of investments because that provides you with some protection. And if some of your investments fall in value, others may rise. And if some are quite volatile, others might be pretty stable. So diversification, it's important to note, will not eliminate your risk entirely, but you can reduce it. So mutual funds and ETFs provide some instant diversification just from their structure alone. So ETFs, which are called exchange traded funds, are, as the name suggests, trade on exchanges. And the other side of the trade is just some other investor, just like you, and not some fund manager. Although when you put your money into a mutual fund, the transaction is with the company that manages it, either directly or through a brokerage firm. And the purchase of a mutual fund is executed at the net asset value of the fund based on its price when the market closes that day or the next, if you choose to place your order after the close of the markets. So both mutual funds and ETFs hold portfolios of stocks and or bonds, and occasionally something more exotic, such as precious metals or commodities. So during the Investing Basics webinar back at the earlier of Financial Literacy Month, the different assets we covered were cash, fixed income, equities, mutual funds, and ETFs. And these can be really great tools used to diversify your portfolio. Now, whenever you invest, whether it be today or in the future, you can diversify in terms of the types of investments you make, whether that's stocks, bonds, GICs, etc. And you can diversify in terms of the location of your investments, for example, in Canada, in the US, or Asia. And you can also diversify in terms of the level of risk of your investments. So there are also a number of diversification strategies that you can adopt, and we will take a look at a few of them. So first, we will look at asset allocation as a diversification strategy, which looks to build an investment portfolio with set proportions of different assets based on an individual's goals. So this means for a long-term investor, the asset allocation decision will be a key determinant of the return of the portfolio over time. So each investor's goals are in part a product of their age, risk tolerant, and investment horizon. And remember the three asset types we discussed in the previous workshop, which was equities, fixed income, and cash equivalents. An asset allocation seeks to build a portfolio made up of a set percentage amount of various asset types. So for example, a more aggressive investor might opt to build a portfolio of 80% stocks and 20% bonds, whereas a more conservative investor might opt for a portfolio of 40% stocks and 60% bonds. But in summary, the impact of asset allocation on returns depends on an individual's investing style. So for the long-term passive investor, the asset allocation decision is by far the most important. And for the short-term investor who trades a little more frequently, invests in individual securities, and practices market timing, asset allocation has less of an impact on returns. The impact of asset allocation on performance is directly correlated with the investment style. But either way, at the end of each year, assets would be bought and sold to rebalance their portfolio to your risk tolerance and ensure a constant portfolio asset allocation. So this slide here with this chart shows the various asset classes and their relative positions each year. And you can see along the top row that one single asset class is not the best performing for multiple, consecutive years. So if we pick a color, let's say orange here, which shows Canadian bonds and shows in the years from 2000 to 2002, that was a top performing asset class. But then from 2003 to about 2006, they were one of the worst performing asset classes. So the key takeaway here is that different asset classes will perform differently at different times. Therefore, if you have a good mix, you'll ensure good overall returns with less risk. Now, on to the third and final risk management strategy. We're going to look at dollar cost averaging. So dollar cost averaging, which is another powerful diversification strategy, involves regular investment of a fixed amount in an asset. So you can take any stock as an example, rather than trying to time the market, which has been shown to be quite ineffective. Dollar cost averaging suggests you ignore the price and fluctuations of your investment and continue with regular and constant purchases. So this means buying stocks through the good and the bad times. This risk reduction strategy is particularly applicable in the long run, or the long scheme of things, over a longer period of time, by buying more at lower prices and buying less at higher prices, which will average out your cost. And that's because by continually buying a stock over time, not only do you increase your portfolio, and never forget about compound interest, you are able to maintain an average purchasing price that is fairly close to the market price, meaning that your portfolio's value should be more stable and less volatile. So as an example here, say you put $100 a month into a stock index over the course of 5 years. At times, the stock index price might be $10 per share, which means you buy 10 shares. And sometimes the stock index may be priced at $5 per share, so you can end up buying 20 shares. Over time, you're averaging out the prices of the stock by buying a set amount each month. Now we're going to move on to a dollar cost averaging example here. So what would happen if you continuously put money into the S&P 500 on a monthly basis over the course of 5 years? Well, in this example, all of the investments you would make would end up profitable. In particular, the investments that you make during the dips here would be doing really, really well. So let's keep in mind that this chart accounts for the stock market activity during the pandemic. So even with the pandemic occurring, all of your investments are still profitable in this particular scenario. So the key takeaways from this section here are, first, to diversify your portfolio and minimize risk. 2, your asset allocation depends on your goals, age, and risk tolerance. So consider buying different types of assets from different countries and different sectors. And 3, that dollar cost averaging is a great strategy for the long run. So moving on from the importance of diversification, and now we'll talk about how to choose stocks for investing. Deciding on which stocks to purchase can be a really complicated and tedious process, but together we can go over some of the steps that you should take when deciding on which stocks to buy. So in this section, we'll be covering where can you purchase stocks from, what to look at when purchasing a stock, and what to consider when investing in the stock market. So first of all, where can you go to purchase stocks? Well, first of all, stocks can be purchased through a licensed broker, and you can buy stocks through a full service dealer. Banks will have one, and there are independents as well. And you may also sign up with a direct brokerage to purchase stocks. So for example, National Bank, Direct Brokerage, Wealthsimple, and Questrade. A robo-advisor is where brokers will tailor a portfolio based on your risk profile, and fees for robo-advisors tend to be in between buying stocks directly and a full service dealer. Although keep in mind that every brokerage and licensed dealer has different fees, structures, and benefits. So for instance, full service brokerages will offer professional investing advice, but this may come at a much higher cost than some of the alternative options. Although you do want to make sure that you do your own research in order to find out which option best suits your own needs. So there are four main factors to consider when buying stocks, and that is company size, industry sectors, geographies, and personal beliefs. So to begin with company size, this is a factor when deciding which stock to purchase. So market capitalization, or market cap for short, shows a company's value based on the stock market. And there's actually a calculation formula that you can use to figure out the market cap of a company. So the market value of a stock times the outstanding shares will get you that market cap value of a company. So for the example here, in the Coca-Cola company, their market cap stands at $240 billion. And as of June of this year, when Coca-Cola stock was at $55.65 times the 4.3 billion shares, that is where you get that about approximately $240 billion market cap. So based on a company's market cap size, they can be then categorized into one of the following market cap sizes. That is micro cap, small cap, mid cap, and large cap. So you can see the micro cap starts on the lower scale with $50 million to $300 million. Small cap moves upwards from 300 million to 2 billion. Mid cap is 2 billion to $10 billion, and large cap is anything greater than $10 billion. Now, to quickly test your knowledge, we're going to throw a little example out, and that is for Air Canada, which has a market cap of $96 billion. And a common stock was at $26.95. So which category would this market cap fall under? I know the math. We have any brainiacs in here doing some fast math? So the correct answer for this is mid cap. And an extra tip here is if you wanted to diversify in this scenario, you'd want your portfolio to consist of different sized companies. So what to look for when buying a stock? We're going to move on to the next section, which is industry sectors, which also play an important role in deciding on which stocks to purchase. So each company listed on the stock market falls within a certain industry sector. So in some instances, this sector of a stock that a stock is in can have a varying effect on the performance of the stock itself. So here are some well-known industry sectors. We have materials, financials, healthcare, energy, information technology. And a stock can be heavily affected by its industry sector. So for example, political pressure on non-clean energy can have a really significant impact on the stock performance of gas or oil companies within the particular energy sector. And then we also have issues as well. Heavy political turmoil is risky, and economic, political, and social situations can change through time. And this is why it is equally important to stay up to date with current happenings and current events, which is particular to geography when deciding in what stock to pick. And this is also really important when considering a company's location, as they're subject to different opportunities and risks, which is based on multiple factors. Oh, are we question or okay, sorry, we're still on the, I'll still continue just finishing up with the geography bit. Yeah, so the company's location, so they're subject to different opportunities and risks. The company is located in a region, again, if it's experiencing any heavy political turmoil, it's probably not the safest environment. moving forward now to personal beliefs, which is another important but often overlooked factor when purchasing stocks. But this is really important when you choose to invest in a company. Especially if you use it often, or if it's a product or a company that you use and strongly believe in, and your personal connection with the company can actually give you a better perspective of the value of the company and what it provides to its consumers. And if the financials and other variables of that scenario make sense, this may be a very viable option when deciding on which stock to purchase. So moving forward, we're just going to discuss the difference between growth stocks and value stocks and what they can offer. So to begin with growth stocks, these are companies that are believed to outperform the market over time because of their perceived future potential. So growth stocks may have fundamentally expansive projects, be a leader in a new industry, or aggressive forecasting for the future, etc. A really good example of this would be companies like Amazon or Tesla. And then you have value stocks, which are companies which are trading below their true value. And as a result, these stocks can be of great value if the reason for the stock being cheap is not related to the fundamentals of the business. However, if the business they are in is fundamentally challenged, and then the stock may be cheap for a very good reason. So you can think about Blockbuster, for example, and movie rentals over a decade ago, and how those stocks plummeted, with the rise of things like Netflix and Hulu Plus and all of those streaming services. So value stocks can provide a greater return than the market average over time, and examples of value stocks will change over time. And so I see. So just going back to the example of Blockbuster there, and just thinking about how challenges they face can create differences in their stocks there. So we can take look at a few more of the more complicated strategies used to decide when trying to pick which stocks to purchase. So first, the price to earnings ratio, which can be potentially used to determine if a company's stock price is under or overvalued. So keeping in mind that this is not a definitive calculation by any means in terms of telling you to buy a stock or not, but a low or high PE ratio is not inherently good or bad. They can be calculated by dividing a company's current share price by its earnings per share. So as an example, as of June, Apple had current annual earnings of about $4.50 per share and a stock price of $125, and so the PE ratio is 28. So a lower PE ratio might mean the company is undervalued, or investors may be losing confidence in the company. Whereas a higher PE ratio might mean the company is overvalued, or investors may be expecting really large growth in the future. And it is very important to look at PE ratios within an industry sector, as different industries will trade at different PE ratios due to differences in inherent profitability, profit margins, growth versus value, stocks, etc. So something else to look for is the debt to equity ratio, or the DE ratio, which is used to determine a company's financial leverage. So to put it simply, this calculation checks to see if a company is using their own money or debt to fund their operations, and to what degree. So the DE ratio is calculated by dividing a company's total liabilities by its shareholders' equity. So in this case, a lower DE ratio means a company is operating with their own funds rather than incurring debt to fund their operations, whereas a higher DE ratio means that the company is incurring debt to finance their operations, which could potentially be a higher risk investment, which can pay off well if the company can invest the debt profitably, But excess leverage might also end poorly for a company if they can't make payments on their outstanding debt. So we do have a short video here providing a deeper explanation on DE ratio.
The debt-to-equity ratio is a measure of a company's financial leverage. Al and Ed both go to the bank for business loans. The loan officer looks at their respective balance sheets. Ed has $120,000 in assets, cash, equipment, and so on. Ed also has $100,000 in liabilities, mostly loans. So Ed's equity is $20,000. The loan officer divides Ed's liabilities by his equity to come up with a ratio of 5. This means Ed has $5 of debt for every $1 of equity. Ed is highly leveraged, so he's a high risk for the bank. His application is declined. Al's balance sheet is much stronger. Al has $150,000 in assets and only $50,000 in liabilities. His equity is $100,000. Al's debt-to-equity ratio is 0.5, $50,000 over $100,000. This means Al has 50 cents of debt for every dollar of equity. Al's low debt-to-equity ratio makes him a low risk for the bank. His application is approved. The debt-to-equity ratio identifies companies that are highly leveraged and therefore higher risk. But no single ratio can tell the whole story.
All right, so with that, we can gather that companies taking on a lot of debt may not perform as well as a company that has less, and this is a good indicator of risk. So using Apple again as an example, in the beginning there was a lot of risk with the company. So by taking on debt, they would not be able to service that debt, but now Apple is making much more money and they can afford the debt, which will increase the broad return for shareholders. Now, as you can see, there is a lot that goes into picking a stock. And in fact, there are plenty more complex strategies used to determine which stocks to pick, which we won't cover in this workshop today. But these concepts are understood by professionals who do this full time and are known as portfolio managers. And they usually have their Chartered Financial Analyst designation, which is a series of 3 exams that will likely take you over 3 years to complete. And if you want to become a stock picker, we strongly recommend starting with a Canadian Securities course, which is a single exam that you can likely complete within a few months. So before we move on to the next section, let's have a quick poll to test your knowledge. So which one of these 4 factors is not a factor of deciding which stock to buy? We have industry sector, a friend's recommendation, company size, and geography. So we're getting a lot of friends' recommendation to purchase, which is the correct answer. I'm so glad to know that we're listening here, and it is equally important to know you want to make choices based off of your own research and your own inquiries, as well as potentially reaching out to professionals for advice. So the key takeaways for this section here is to first understand the fees associated with purchasing and selling stocks. Second, that there is a lot that goes on into choosing stocks. And third, develop your own judgment, and you can also reach out to professionals. All right, moving into the third section here, we have alternative investments. So by now you would have heard about investments regarding stocks, mutual funds, ETFs, but what are some other options? We can move on to the next slide and take a look. So before we really dive into this section, we want to stress that these investments can get a little bit complicated. So research is fundamental before diving into any of these sectors. Alternative investments can include higher risk. So educating yourself is truly essential when investing in any of the following topics, being 1, cryptocurrency, 2, precious metals, and 3, real estate, as alternative investment options. So to start off, we'll begin with cryptocurrency. What is it? How does it make you money? What are the risks? And how do you buy it? So before we get started, we will watch this quick video to get a better grasp about what cryptocurrency is.
Today, cryptocurrencies have become a global phenomenon known by most people, but understood by few. In 2018, you'll have a hard time finding a major bank, accounting firm, software company, or government that hasn't researched cryptocurrencies or started a blockchain project. Beyond the noise and the press releases, many people often fail to understand the basic concepts. So let's walk through the whole story. What are cryptocurrencies? Satoshi invented Bitcoin in 2008 as a peer-to-peer electronic cash system. To realize digital cash, you need a payment network with accounts, balances, and transactions. That's easy to understand. One major problem every payment network has to solve is to prevent double spending. That is, to prevent one entity from spending the same amount twice. Usually, this is done by a central server who keeps records of all the balances. In a decentralized network, you don't have this server, so you need every single entity of the network to do this job. Every peer in the network needs to have a full list with all the transactions to check if future transactions are valid, or an attempt to double spend. But how can these entities keep a consensus about these records? If the peers on the network disagree about one single minor balance, everything breaks. They need absolute consensus. Nobody knew how to achieve this until Satoshi proved it was possible. Cryptocurrencies are a key part of this solution. To illustrate this, we'll look at the transactions on the network. A transaction is a file that says, Bob gives X Bitcoin to Alice and is signed digitally by Bob. Once signed, the transaction is broadcasted to the network, sent from one peer to every other peer. This is standard P2P technology. Nothing special happening here. After a specific amount of time, the transaction gets confirmed. Only miners can confirm transactions. This is their job in a cryptocurrency network. They take transactions, stamp them as legitimate, and spread them in the network. After a transaction is confirmed by a miner, every node has to add it to its database. It has to become part of the blockchain. For this job, the miners are rewarded with cryptocurrency, for example, bitcoins. Anybody can be a miner. They just need to use some of their computer's power to qualify for the task. Every miner competes to solve a cryptographic puzzle. After finding a solution, a miner can confirm the transaction and add it to the blockchain. As an incentive to do this, they then receive a payment from the network in the form of a cryptocurrency. In this way, a network of independent actors are economically incentivized to maintain the legitimacy of the transaction history. So that's the gist of it. Cryptocurrencies are the key to the complex digital cash problem that Satoshi solved: how to maintain integrity and consensus across independent and potentially malicious actors. Cryptocurrencies are essentially the monetary incentive offered to anyone willing to keep the network secure.
So from that video, we learned that a cryptocurrency is a digital asset or currency which is exchanged entirely online. Many cryptocurrencies are decentralized, which means that direct and secure peer-to-peer crypto transactions exist without the need for an intermediary or a middleman. And cryptocurrency also uses strong encryption to verify transactions and mitigate fraud. So a big example of cryptocurrency would be Bitcoin. And this is a cryptocurrency that currently lives on the internet. Bitcoin went live first in January of 2009, and it has since gained traction as it's existed throughout the years. And it does not rely on a central authority, which decreases the risk of failure as well as corruption. And transactions are all recorded on a public ledger constituting a blockchain. So how do people make money using cryptocurrency? The value of cryptocurrency is based on several factors, including daily trading patterns, belief in a future use, and uncertainty in fiat and currency and current economy. So for daily trading patterns, high volume traders will dominate the small market, which results in volatile price fluctuations on a day-to-day basis. For belief in a future use, as mentioned, crypto is relatively new and has not yet been proven. So some view a future where cryptocurrency is actually the default form of currency across the world. And uncertainty in fiat currency and current economy. As the pandemic has shown us, many feel uncertain about the value of our current currency. which is dollars created by governments, which has resulted in a surge of crypto buyers. So there are risks, of course, with these cryptocurrency as an investment option. The first being that because it's relatively new technology, it hasn't been proven yet at scale. As well, a majority of cryptocurrencies won't be around in the long term, whereas some might. But remember that it is an unproven space, so we don't know which cryptos will leave their mark and which ones will not. As well, it is very volatile since the crypto market is relatively small and dominated by large traders. So the day-to-day value of any particular coin is heavily influenced by trading platforms rather than the actual value of the coin itself. And remember the concept of diversification. So you have the option to diversify your investments by potentially putting a small amount of your portfolio into cryptocurrency. Now, how do you buy it? Well, there are three main ways to get your hands on some crypto. The first being crypto exchanges, which is the most efficient way to buy crypto. They have the lowest fees in the industry. However, that comes at the cost of speed, as you will need to create an account, get yourself verified, and then do a bank transfer. And be wary of fees, as many traders and exchange sites tend to charge a fee to purchase their cryptocurrencies. The second being fintech companies. Certain existing companies now offer users the ability to buy and sell crypto on their own platforms through though their fees are higher than crypto exchanges. So what you buy cannot be transferred elsewhere, meaning like to an external wallet. An example of this option might be something like PayPal. The third option is with a card. Some platforms will offer users the ability to buy crypto with a card, which are often sought after because of the speed, but they do come at a hefty cost, which can be about a 3% fee. Precious metals. So moving on to our next alternative investment option. What are precious metals? How can they make you money? What are the risks associated, and how do we buy it? So precious metals such as gold, silver, and platinum are all recognized as really valuable metals. And this is primarily because of their security and tangibility. So they are a physical asset. There's limited supply, and mining will continue to slow until our precious metal reserves are depleted entirely. They also cannot be inflated, meaning it cannot be, we can't print more of it, unlike our current money. As well, there is instant liquidity. So most metals can instantaneously be sold back on the market for cash. And as well, each precious metal has its own unique risk and opportunities. So for the first example about gold is that gold doesn't rust or corrode, and it's mainly used as jewelry and also as a form of currency. And then the second example, we talk about silver, which is also known for its intrinsic value, but is more commonly being used as an industrial metal, which is more volatile. And over time, the value of these physical assets will go up or down based on the market, and some precious metals are known to be more volatile than others. So in terms of making money with precious metals, there are some things we have to take into consideration. The first being systemic financial concerns. So while banks and money are perceived sometimes as being unstable, many prefer to invest in precious metals because they are physical assets. As well as war and or political crisis, many will rush to hoard precious metals during this time as it's considered to be a safe store of value. And also inflation. So when fiat currency is experiencing heavy inflation, many will opt instead to invest in precious metals as they hold or increase in value. And this is because, as we mentioned, we can't just print more of it, which means its value cannot be inflated, unlike fiat currency. So the risks associated with precious metals, So precious metals markets experience a fair level of volatility due to hoarders. When hoarders are offloading their precious metals, prices tend to fall because of the imbalance between sellers and buyers in the market. Another risk is if a metal has industrial uses, like silver, for example, in solar panels, that can drive up both the demand and the prices. However, if there's an alternative, cheaper metal that can be used, then that might hurt the value proposition of something like silver. So in terms of buying precious metals, they can be purchased from reputable websites or your bank. And prices will be determined by the market value multiplied by the weight of the precious metal you're purchasing. And you'll need to decide where to store your precious metals if you end up buying physical assets. So you have options such as the bank, which would have a fee associated, as well as self-storage, which might have, minimal fees or no fees at all, although it is a much higher risk. And you can also choose to purchase ETFs and mutual funds, which are focused on precious metals, and a really great way to quickly diversify your precious metal portfolio and not have to worry about the storage risks or costs involved. So finally, we're going to cover real estate as an alternative investment option. So there are two purposes for buying real estate. The first, buying and selling principal residence. So a principal residence is the primary location where someone lives. And if the property was solely your principal residence for every year that you owned it, you do not have to pay tax on any gain in value when you sell it. The risk associated with this investment is that if there was ever a recession, this could mean that your job is at risk, and therefore an issue creates issues with things like mortgage payments. A prime example of this is right now and how COVID and lockdowns have affected people's income. You might also overpay for your home if the real estate is in a bubble, and this means you'll be purchasing at prices that may be inflated due to high demand and low supply. And then the second point there is investment properties. So an investment property is a real estate property purchased with the intention of earning a return on the investment, either through rental income, the future resale of the property, or potentially both. The property may be held by an individual investor, a group of investors, or a corporation. So the goal when people invest in properties is usually to make money, and there are three different ways of doing that. So plan a way to have the first being positive cash flow, 2 being capital growth, and 3 tax advantages. And some of the risks when it comes to investment properties is it's not as liquid as other investments. This market is not predictable, so some months or some years you could have a steady income, whereas others you may not. And this is due to a variety of factors, such as tenants leaving or unforeseeable issues, like if something were to break at the property and you're faced with extensive maintenance fees. So moving on to the next slide, we'll have REITs, which is an acronym standing for Real Estate Investment Trust. And this investment is managed by a company that owns, operates, or finances income-producing real estate. This can include commercial real estate ranging from office buildings, apartment buildings, to warehouses, hospitals, shopping centers, or hotels, as well as residential real estate. So REITs provide all investors the chance to own valuable real estate by allowing them to participate in the market value change of the underlying real estate, access dividend-based income, and help communities grow, thrive, and revitalize. So in terms of how it works, the REIT collects rental income, pays its expenses, and then distributes almost all its remaining income, at least 90% to unit holders. And they do this to avoid paying tax inside the trust. So the unit holders are taxed upon receiving the distribution, and REITs are required to distribute at least 90% of taxable income annually to shareholders as taxable dividends. So in other words, an REIT cannot retain its earnings. REIT shareholders pay taxes on distributions at ordinary rates versus the lower qualified rate. And some of the income from an REIT may be a return of capital, which is then allowing one to use the lower capital gains tax rates on those returns. So it can make sense to hold an REIT in a registered account like a tax-free savings account or an RRSP to ensure tax efficiency and also to avoid some of the challenges in tracking REIT income in a non-registered account. So the risks of an REIT include issues like property prices that may go up and down and liquidity. So although real estate prices have risen, the past does not necessarily dictate what will happen in the future. So real estate prices have taken a massive hit before and notably had a really big dip in the early 1990s when property prices went very low, taking over a decade to regain its former price. For people that can afford this dip, it is obviously not a problem, but for those who don't have extra cash, might be in a great deal of trouble during times like this. And at the end of the day, there's no guarantee that you'll get a positive return. And as well, liquidity is also an issue for non-traded REITs, which means it's difficult for investors to sell them. And lastly, publicly traded REITs have the risk of losing value as interest rates rise. So how do we buy it? So Canadians can purchase an REIT share the same way that they would buy any other stock. So you can purchase shares in an REIT mutual fund or an REIT exchange traded fund or ETF. And as well, you can also purchase REITs from a broker. So the key takeaways from this section include cryptocurrency, which is a new form of online currency, volatile, and it's really important to do extensive research on it. 2, we have precious metals and their unique attributes. They're physical assets as well as very liquid. And 3rd, we have REITs, which are an alternative way to start investing in the world of real estate. So in summary, let's review what we have learned today. So we covered 3 important sections. In the first section, we covered the importance of diversification and the 2 follow-up strategies which can be used to diversify your portfolio, which, if you may recall, they were asset allocation and dollar cost averaging. And in the second section, we discussed the process of buying stocks and the different factors you must take into consideration, and as well as completing further research when purchasing stocks. And in the third and final section, we discussed 3 options to investments, what they were, how they make money, and where to buy, as well as the risks associated with each. And these alternative investments were cryptocurrency, precious metals, and real estate. So in terms of the first section of diversification, we first learned it's important to diversify your portfolio to minimize risk. So recall some of the ways you can diversify your portfolio through types of investments, locations of investments, and the risk associated. And secondly, your asset allocation depends on your goals, age, and risk tolerance. So consider buying different types of assets from different countries and different sectors. And 3, that dollar cost averaging is a great strategy for the long run. And in the second section, we first covered how to understand the fees associated with purchasing and selling stocks, and that there is a lot that goes into choosing stocks, as well as the importance of developing your own judgment. You can also reach out to professionals, but remember, it is most important not to simply rely on a friend's recommendation. And as in terms of alternative investments, the first being cryptocurrency, which is a new form of online currency. And we had precious metals as well as REITs. So coming out of the workshop, we really hope that you are much more comfortable managing your investment risks by applying techniques like dollar cost averaging and diversification to your portfolio, that you'll be able to analyze and understand the potential long-term value of a common stock of a company you choose to invest in and the important metrics to follow, and also know about some alternative investment opportunities and try to diversify and enhance your risk-adjusted returns. So moving forward, these are some of the key steps of action to evaluating and making investments. So first, doing your own research. So pick a company where you like their products and try to understand the value of the company and how the stock price has moved around. Ensure that you have calculated the relevant ratios, observe the stock's performance or investments returns, and overall familiarize yourself with the complexities. Second, that you should begin by setting up a practice account at a discount broker. And by using a practice account, you can become aware of the fluctuation patterns of investments. 3, being that you can talk to a financial advisor about investing. And 4, that you can check out more program resources. So be on the lookout for additional program resources, which can help you better develop your judgment and help increase your investment returns. And there are plenty of additional resources in the reference handout that has been sent to your Lakehead emails.